So it's confirmed. We're in a recession and home prices have started to cool off for the first time in a long time. We're now seeing a shift in the real estate market and the overall economy. The media's hype is causing some buyers to shy away from the market. Therefore, we need to dig into the data for the real story and, more importantly, see if there are any opportunities for us. Today I'm going to be talking about three things. Will home prices fall and by how much? What are the risks to keep an eye on? What should you do if you're a buyer or investor looking for opportunities? The last part is super important, so make sure you stick around to the end. When you talk about the opportunities in real estate, it's important to look at what wealthy people are doing. Blackstone, one of the largest investment firms in the country, has raised their largest real estate fund to buy more property. The media is overhyping market conditions because fear drives the news. For example, a recent story said home prices had their biggest decline since 2011, but if you read more, the decline was less than 1%. With home prices up nearly 20% in the last year alone, a decline of 1% is hardly cause for concern, but it does mark a change in the market. What you're seeing is a crash in listing prices. There have been more price reductions in the last 3 months than any previous quarter. That's because sellers and listing agents seem to be caught off guard during these shifts, and they're pricing their homes as if none of this is happening. So, how much will real estate prices fall? The answer is less dramatic than what the media is telling you. The data firm CoreLogic is predicting home values will flatten out, not go down. This assessment is on a national basis and each market is different. If you're in a hot market that spiked quickly, you could see prices decline sooner than later. After reading several reports on this topic, I'm going to predict that values in those markets are going to pull back approximately 10%, and this is going to happen over the next 12 to 24 months. There's one major risk to keep an eye on, which I'll get into shortly. As of right now, given the current data, this is what's most probable. It's important to know that what really caused prices to spike was low supply, cheap money, and high demand for housing. As of today, the cheap money has been taken away, which has cooled off demand. Remember, when you look at these declines, you must look at the final closed sales price, not the list price. Another reason you're seeing demand decrease is recession fear. When you get to one of these inflection points, many buyers become confused or scared. Confusion causes many buyers to go to the sidelines initially, which is why you see this sharp decline in demand. But over time, this seems to normalize. Many of these young home buyers fear home prices will crash like they did in 2008. From 18 to 22, the National Home Price Index was up over 43%, and in certain markets, they were up even more. Many people feel this created another housing bubble. You may be surprised when we look at the characteristics of today's market versus 2008. Housing bubbles are typically fueled by debt, meaning people take on too much debt to buy properties. This is called leverage, and in the years leading up to the last crisis, there was too much leverage. People weren't putting much money down and were using their homes like ATMs. Another factor for a bubble is extreme speculation. This means people buy the asset with the sole purpose of making quick, fast money. Before 2008, real estate was seen as a get-rich-quick investment, as opposed to the buyers of today holding property for the long term. It's important to note that today, Americans are sitting on a record amount of home equity. Most homeowners in this country have more than 20% equity in their homes, and only a small fraction do not have any. Back in 2008, homeowners had very little equity, and when prices pulled back a little, they were quickly upside down. That is what fueled foreclosure activity. Looking at the current data, foreclosures are at a multi-year low. If you have equity, rather than default, you can simply sell the home. The main reason someone would walk away from a property is they don't have any equity. Given the fact that there's all this equity out there, even if home prices pull back a little, you're not going to see this wave of foreclosures. There's a general premise when buying a home that it's going to go up in value, but that's not the sole reason to buy. There's real utility with owning a home in a neighborhood your family wants to live in. There are real advantages to owning rental properties for the long term. Another important factor between the current market and 2008 are mortgage lending standards. In today's market, it is more difficult to get a mortgage than it was before the crash. Today, you must qualify and prove you can repay the loan. Now, the last thing to note for this section is the supply issue. If you look at a chart of single-family homes being built, you'll see that after the crash of 2008, that number went down substantially. In fact, you'll see this figure has been well below the 50-year average for the past 14 years. This means home supply is not meeting the demands of our country. This is important to consider when you think about what's going to happen with home prices over the coming years. Now, before we get into the opportunities I'm seeing, let's get into the one risk factor which could change all the predictions. As I said earlier, the main reason for the decline in demand was because money became more expensive. Interest rates for home loans went up, and they went up fast. We've seen rates increase from 3 to 6% in the past 8 months. Now, Keep in mind, when these rates were in the low threes, that was too low and was more an anomaly based on what the Fed was doing at the time. Even so, a move from 3 to 6 in such a short period is unprecedented and will take some time for buyers to adjust. Currently, mortgage rates are hovering in the high 5s, low 6s, which is the upper end of where they've been over the past few months. If they go much higher, that will present a real risk to the housing market. The reason is most buyers finance their home purchase. In those cases, they're really buying the monthly payment, not the price of the home. The higher these monthly payments move, the less these buyers can afford. If rates stay in the current range, these predictions will remain the same as buyers will adjust to the new norm. However, if rates move towards 7% or higher, that would be cause for concern and my prediction for home prices would be worse. Most experts don't predict rates will go much higher, but I want you to know about this as it is the single most important factor to the housing market. Now, the opportunities. Many sellers have listed their properties too high. These properties are sitting on the market for a long time and the listings are stale. A year ago, you could list a property in any condition and you'd get 10 offers, but that's just not the case today. Today, you must have a good product and price it properly. On some of these stale listings, buyers are going to have an opportunity to get the property well under the asking price and or with credits from the seller. For example, you can get a seller credit to buy down your interest rate, lowering your monthly payment, or use it to offset closing costs. Nobody can predict when rates will come down, but I know there will be an opportunity in the coming years. Remember, the home is permanent, but the rate is not. In fact, Fannie Mae recently predicted rates are going to cool off into the mid-4s in the next year or so. Ideally speaking, you will be able to take advantage of these lower home prices, and when rates do pull back, you can refinance to reduce your monthly expense. Now, if you need an even larger credit, you can structure repairs to be paid by the seller during the transaction or at closing. This gets a little more complex and you want to work with a realtor and a lender that know how to structure this. Every deal is unique and your ability to negotiate with a seller is going to depend on your specific market. Smart investors make the most money betting on what is most likely to happen. While there is a small risk of things getting out of control and everything drops, the more likely scenario is something way less dramatic based on all the data points we're looking at today. I've talked to so many people who are waiting for the market to crash, and the thing is, last time it crashed, very few people were waiting for it to crash. They were in debt up to their ears, they were over-leveraged, and they weren't prepared for it. When you talk to people today, they're prepared for this crazy event, which means the crazy event is less likely to happen. In closing, if you have any questions or would like to continue this conversation, I've put a link in the description where you can book a call with me. I'm going to be watching all these data points and will bring you the information as it becomes available. Until then, take care of yourselves and I'll see you on the next video.